So I hope that you can all see my screen now.
Yes, we are seeing it.
Okay, perfect. So thanks a lot for hosting me. It is a real honor to present at your research seminar at the Istanbul Gelisim University. And I'm extremely grateful that you have contacted me and allowed me for this opportunity to present at your research seminar, and thankful for you and your team for organizing it. I hope that this presentation will be useful for upcoming bachelor, master, and PhD theses, as well as for upcoming research projects. The way I'm used to hold this kind of seminars is that whenever you have questions, please just interrupt me so I can explain in detail like how things are working, so no one gets lost and you're having like most benefit out of it. This presentation, as Onur mentioned before already, is not about one of my recent research papers. It's basically about the journey of connectedness approach, which accompanies me already since my master thesis when it was introduced by Nikolaos Antonakakis to me. So this TVP-VAR approach was my master thesis, and later on I continued this journey throughout my PhD and also postdoctoral research. So this presentation is therefore mainly about you trying to get an introduction into this field and being interested in that field and potentially use it also then for your upcoming research projects. Also special thanks to Kamil Yilmaz, who is one of the leading Turkish research scholars and the co-developer of the connectedness approach in collaboration with Diebold. And they have published the first paper in 2009 in the Economic Journal, and afterwards refined the methodology or generalized it in 2012, publishing it in the International Journal of Forecasting. And in 2014, they have illustrated how multivariate time series analysis and this connectedness approach can also be combined with network analysis and survival analysis, which got published in the Journal of Econometrics. So here I will introduce you like the basic framework and its elements, as well as several extensions that have been frequently applied in research. Nonetheless, I'm not covering all of the different approaches because this is, as Onur mentioned, like nowadays a widely researched field, and hence there are like hundreds of different kind of approaches already available. So without further ado, I will now start with the presentation. So I will start from the very beginning so that also someone who is not familiar with quantitative methods understands at least the intuition behind how this connectedness framework works. So we are starting from very simple multivariate linear regression models and how we can create a vector autoregressive model from it. Then we are coming to the VAR toolbox, seeing like range of causality, how you select the optimal lag length, impulse response functions, forecasting, and the forecast error variance decomposition, which is central for the connectedness approach. And then we come to the original connectedness approach, which is at that point, you could say nothing else than a summary statistics based on the forecast error variance decomposition. And afterwards, we're going then to several extensions, which are nowadays quite popular. And then from connectedness to R squared, because R squared is one of these metrics every one of us is familiar with since introductory statistics classes. And finally, which is also of crucial importance to me, how portfolio management is now part of, or it can be combined with the connectedness approach. So first I would start with what creativity is, because some of those models I will present are created by myself. And I think that, or I agree with Mark Twain that there is nothing like a new idea or something like this is rather impossible. It's more like combining what is already out there. And by combining it, you're creating something new. And this is also what Diebold and Yilmaz have done. And hence, creativity is then just nothing else than connecting things. So what do we need to know in order to understand the connectedness approach? Basically, it is essential to understand how vector autoregressive frameworks are working. There are different kinds of vector autoregressive frameworks. Either it's based on normal linear regression models, on quantile regressions, then we have lasso, ridge, and elastic net. So there are multiple kind of options. And as long as we have estimated this VAR type of model, we can always apply the connectedness approach. And based on those VAR type of models, we will then have to understand how impulse response functions and forecast error variance decompositions, which are also related to each other, are connected. So an impulse response function, you could assume, is that you're estimating multiple linear regression models, and then you're implementing a shock in one of this regression, which leads then to an increase in your y variable. And as the other kind of regressions have this y variable in its lagged form in there, one period later, it will also influence all the other kind of variable. And this is how this shock basically is traveling through the system and through time. And hence, we can then create this impulse response function, which shows nothing else than how a shock in one variable might cause other variables to move. And based on this, you can create risk management tools and portfolio optimization models. The forecast error variance decomposition is then also based on impulse response functions and tell us how much one variable can explain out of 100% of the forecast error of another variable. The higher it is, the higher is its influence on the said variable. And this is basically everything we need to know in order to understand how connectedness measures can be interpreted and how they are created. So we are starting now with a normal multivariate linear regression model. And as we are all familiar with this, we have one dependent variable and multiple independent variables. Here we assume we have k independent variable, and then the error term is always assumed that we have a mean of 0, which is the zero conditional mean assumption of the Gauss-Markov assumptions. And as it's normally distributed, this whole distribution can be characterized by the mean and the variance. And this is then nothing else than residual variance. We can also write this formula in a more compact way by just using a sum. And if we want to use it in an even more compact way, we are just using linear algebra. This is important later on, as this formula will be used multiple times. And now, in order to understand how each of these vectors and matrices look like, we see how they are defined below. So y, for instance, it goes from the very first observation to time t. X, we have the ones for the intercepts, and then we simply have the observation of the first variable, of the second variable that goes also from 1 to t, and the kth variable. Then u is also a vector, and in our case here, the regression coefficients is a vector of size k times 1. From the multivariate linear regression model, we are now moving on to the autoregressive model. And as we can see, based on the third formula, that's actually exactly the same as a simple OLS model. The only difference is that it's a special kind of multivariate linear regression model, namely that the independent variables are now lagged variables. So they are basically the lagged version of your dependent variable. And hence you only have to slightly adjust those matrices. Nonetheless, the interpretation will stay exactly the same. And we are calling this an autoregressive model. And now we are going to a vector autoregressive model. And as we see, the only extension here is this vector up front, which basically means that we no longer have a scalar as our dependent variable. Now we have a vector, which means that we could assume having the US, the UK, and the German stock market returns on our left-hand side. And then on our right-hand side, we have the lagged values of all of those three markets. Hence, we would now assume that the US stock market returns in period T are driven by the US stock market returns of yesterday, as well as the UK stock market returns of yesterday and the German ones of yesterday. So here we have then nothing else than 3 linear regression models and estimating also all those coefficients. Now, interestingly, our error term is no longer a scalar or like a vector. It's now a matrix, basically. saying that we are now having, instead of a simple variance, a variance covariance matrix. Because now we have 3 error terms for all the 3 markets, and hence there could be potentially correlation between those errors. They would be on the off-diagonal values. So that's, for instance, in our case, a 3 times 3 matrix. On the diagonal, we have our variances, and on the off-diagonal, we have our covariances, like how the market residuals are correlated with each other. Also, this could be represented in a different way, simply using the sum. This is a widely used kind of formula, or we are using it also in a linear algebra kind of fashion, which leads then to the following mathematical notations. So here we would have then all the kind of dependent variables in a vector form. It's exactly the same as here, but here we have only like one value, like a scalar, and here we would have a vector that is stacked on each other. In X, it's the same is true for U. And for B, now the interesting thing is it is no longer a vector as we had it here. It is now a matrix, because B1 in that case, which illustrates the VAR coefficients of the first leg, it is now a K cross K matrix. And one of those K cross K matrix looks like this. On the diagonal value, we have now the effect a lagged value influences of the same variable influences itself, while the off-diagonal value are now illustrating how, for instance, the UK market, the lagged values, are influencing the US market in time t, or the German market, the lagged value of the German market are influencing the US market in t. The second one would then be the effect the different markets have on the UK, and the last one would be then the effect on the German market. And this is now the variance covariance matrix, where here on the diagonal, we would have our variances, as in the previous case in the multi-linear regression models. And on the off-diagonal case, we are having our covariances. So this basically means that any kind of ER model is nothing else than a specific multivariate linear regression models, where the independent variables are the p-lags of the dependent variable. The VAR model itself is therefore nothing else than k MLRs. So if you have 3 markets, you're just estimating 3 linear regression models separately, based also on p-lags. And if we have now a VAR model where the different markets are not influencing each other, but only like the own lagged value are influencing each other, then this would simply collapse to a simple autoregressive model. This could be illustrated here. It would basically mean that all the values on the diagonal would be different from 0, while all the off-diagonal values would be equal to 0. In that case, the VAR is simply collapsing to an AR model. So now we come already to the VAR toolbox. So the first one that is of crucial importance is the Granger causality test. The Granger causality test is testing whether another market, like the lagged value of another market, is influencing the market of interest. If there is no significant influence, it's like an F test. It's either like it is influencing it or it's not influencing it. It means that we are not using any other kind of markets trying to explain the market of interest. And then basically we are back to the case that the VAR would collapse to an AR model. Nonetheless, if the Granger causality test would be significant, it would mean that now other markets should also be taken under consideration if we are estimating the US stock market return, for instance. And if that is the case, we need now to figure out how are we estimating our VAR models. And there are multiple options. So the ordinary least square case is a special case. It assumes like normality and that they're independent of each other. And hence you can estimate it like equation by equation. The problem might be that in financial econometrics, we often have the case that standard errors are not normally distributed. And if they are now multivariate t-distributed, you have to use the maximum likelihood estimations. If you have maximum likelihood estimation and the error would be a Gaussian, then basically the MLE would converge to an OLS model. So it's another special case of it. And finally, there are also quite a lot of Bayesian vector autoregressive models. And they are trying to impose some kind of restrictions on the prior in order to decrease the problem of overparameterization. So a very common prior is that we are assuming that all the coefficients are equal to 0. And hence, as soon as we are estimating all the kind of different VAR coefficients of all the different lags, what we are doing is we are trying to let the coefficients go down 0 in order that there is no random influence when it comes to predictions. That's especially important for large systems. So now, as we know basically what variables might influence each other, how to estimate it, we now need to figure out how many lags should we use. Should we only take under consideration the returns we observed yesterday or like even a week ago? And for that purpose, we have different lag selection criteria. We have the Akiyike information criterion, the Bayesian information criterion, or the Hanna-Quinn one. Personally, I would always prefer the Bayesian information criterion because it leads to the most parsimonious model, which means it's the smallest model and hence it would not be heavily influenced by some random fluctuation. The ARC would often lead to quite large models, and those models are usually doing a poor job when it comes to forecasting performance. In another step, we also have to test for stability, because VARs, if you estimate them, it could be that they are non-stationary, meaning that they would produce explosive paths. So whenever you would forecast, for instance, the stock market return of the US, it could be that if the forecast goes to infinity, that also it goes either to plus infinity or to minus infinity, which would not really make much sense. But if you put it in log terms, it would basically converge towards 0. And in order to avoid this, we have to always test for stability in every point in time. So when we use, for instance, a rolling window VAR, meaning that we are rolling over the sample. We are taking like the first 200 observation, estimate one VAR, then we go one step further, estimate the second one, and then the third one until we reach the end of the sample period. And what is also always of substantial relevance is the residual analysis, because here we then figure out whether our estimated model was correct or not. So we are taking the residuals and test whether we still have autocorrelation left. If we have autocorrelation left in the residual, it means that we have selected an incorrect number of lags. If we observe heteroscedasticity, which is often the case in financial econometrics, it means that we have to take under consideration that the variance of the residuals are varying over time and we have volatility clusters. And in most cases, we are having the assumption of normality, which is also something we can test with the Sharp-Berat test in the end. Another tool is forecasting. We can forecast the point as well as the confidence interval. And as we are always like forecasting just the returns and the interval, what we are doing is we are aggregating them by always calculating like 1 plus the return, also with the intervals, in order to figure out whether we would assume that in 10 days, for instance, this stock would make profits or losses, which could be then created a trading strategy. Now we come to impulse response functions. An impulse response function is nothing else than we are interested in how a shock in one of those variables, in one of these 3 markets, for instance, is spilling over to all the other markets. So for instance, in 2009, when we had the global financial crisis, we had a shock in the real estate market in the US, and obviously also Europe and the rest of the world were affected. Then there are some specific kind of channels, and we are interested in how much does the shock in the US real estate market influences, for instance, the equity market in Asia, in Singapore, and so on. And for that purpose, there are 2 different approaches. The first one is the orthogonalized impulse response function. Here, the main problem is that we need to isolate shocks, which means that we need to create a causal ordering, which is often kind of problematic because we would not know whether the US market is driving the UK and the German market in the same point in time, while the UK market would drive then the German market, and the German market is only influencing itself. The ordering could also be different. It could be that the German market is driving all the others. And as you can see, there are multiple different kind of ordering. As long as you have just a small network or a small number of variables, that's not too problematic. The issue comes if you have 10 variables, for instance, because there are then n factorial options for this. So you're calculating then 10 times 9 times 8 until you reach 1. And so it means that pretty quickly you reach a number that is in the millions, and you would have then to estimate millions of different VAR models. And in the end, in case the results would differ from each other, which is very often the case, you would not know which of this VAR model is actually the right one. And so people in finance were trying to move away from this orthogonalized impulse response functions and use the generalized impulse response functions. And here we are taking under consideration the correlation, but what we are doing is we assume that the impact of the shock is nothing else than the difference between a system where we once shock this variable, see then the effect, and subtract what is happening if the shock would not have occurred. And then we assume the difference would be only explained by the shock in this variable. And the forecast error variance decomposition is then nothing else than based on the impulse response functions. In that case, it represents the proportion of the forecast error variance in your dependent variable that can be explained by one of the independent variables. If you sum all of those fractions up, it always reaches 100, which means that 100% of the forecast error variance can be explained by the explanatory variables. And the higher the fraction is, the more important this variable is in terms of the forecast error variance. There are also the two different options, either the orthogonalized one or the generalized one, depends on which impulse response functions you're using. And then the connectedness approach is nothing else than a post-processing toolbox, let's say. Based on the forecast error variance decomposition, you can now do some summary statistics. You're calculating what was the average effect this one variable has on all the others, as well as you can calculate how high was the effect all the variables had on a single variable. And then you're calculating the net effect. So this one variable, was it driving the network? So was it influencing the network more than being influenced by all the other variables or not? If it is positive, it means it was driving the network. It has a larger influence on the others than the others had on this one. And if it is negative, it means the effect this variable had on the others was smaller than the effect the others had on that variable. And finally, you can also then calculate how highly interconnected is the system. So if all of them are highly correlated and the effect of them is, for instance, high and symmetric, it would mean that they are co-moving, and hence the total connectedness index is around 90%, meaning that on average, a shock in one of the variable gets transmitted to all of the others. So 90% of a shock in one variable is transmitted to all of the others. While on the contrary, if 0% of a shock in one variable is transmitted to the others, it means that this is rather independent, and hence it could be used for portfolio diversification. So now we are coming to the orthogonalized impulse response function. And for that purpose, you only have to understand that the variance covariance matrix we have here comes from this VAR model. And now we are decomposing it. For this decomposition, in order to have like two matrices that if you multiply it with each other results in the variance covariance matrix, we're using the Cholesky decomposition. There would be multiple options, but the reason why we use the Cholesky decomposition is because we're either getting an upper triangular or a lower triangular matrix, which includes all zeros. And now, if we have now ET multiplying by this P, so here you would have to assume that there is E, then it means that if we shock the first variable, it would only multiply itself with P11, hence it's only influencing itself, while it's not influencing one of the others. If we would have then a shock in the second variable would also influence itself, but it's also influencing the first variable. So as you can see, like there's then a clear structure. So it always influences a shock basically down the line here would always influence the variable itself and all the others that have been seen before. And now the problem is that we could basically rearrange these regressions and get different results. And in order to calculate now the impulse response functions out of this, we have now to convert our vector autoregressive model into a vector moving average. And this is done via the world representation theorem. So this formula here is our simple VAR model. So if we go back, it is exactly this model here. And what we can now do is we could say, okay, yt is equal to this formula. So yt minus 1 is also the same as this formula. But now all the p's are basically lagging one step behind. And if we would continue this constantly, we would get this vector moving average with a lag of infinity model. That's now the VMA infinity model. And these are no longer the VAR coefficients, those are now the VMA coefficients. And as we can see, the VAR here starts with 1 and goes to P lag, like 5, for instance, covering the last 5 days, while the VMA goes from 0 to infinity. And if we plug in 0, we get now yt 0, so it's just ut. And now ut would directly influence yt, as it is here. And hence, theta 0 is equal to an identity matrix. All of the others are then different from the identity matrix. If all of the others would be like zero matrices, it means that the past is not having an effect on yt, so any kind of lagged value. If they have an influence, all of these impulse response functions of like the forecast age, like age could be like 5. How does like the impulse response look in 5 days? Can be easily calculated by using theta h times p times this matrix. And here the problem, as I mentioned before, is that if you have k variables, you have k factorial different variable ordering. And this is also something that was trying to be addressed by Klösner and Wagner, which calculated then multiple kind of approaches via permutation matrices in order to figure out how robust the results of the original 2009 papers have been. In the next step, we are calculating then, based on the impulse response functions here, the forecast error variance decomposition. Here, those E, I, and EJ, those are zero matrices, which means that it's a vector of zeros, and on the J position, there's a 1. So now we are multiplying, or now we are getting out of this impulse response function the ij position, which is basically the influence variable I has on variable j, and then it's getting normalized. In the end, we are getting this table. And this table is called the forecast error variance decomposition table. It shows us how the unlagged values in the first variable influences itself in the future, how variable 2 influences variable 1, how variable 3 influences variable 1, and how variable k influences variable 1. So the whole first row basically just illustrates the effect the other variables have on variable 1. The second row is the effect all the other variables have on variable 2. And here, if we look at it on a column-wise basis, we see now the effect variable 1 has on all the others. So variable 1 has on variable 2. Variable 1 has on variable 3. Variable 1 has on variable k. And if we would now sum it up in both directions and calculate the differences, we are getting our connectedness measures. But first, we also have to go through the generalized impulse response functions. So this is not dependent, so it's independent of the variable ordering, which makes it now like the main workhorse when it comes to connectedness measures. And the idea here is that our impulse response function attributes the effect of the shock in one variable on the system by calculating what is the expected value of our dependent variable in 5 days, for instance, based on a shock in ut that is equal to delta I. And this delta I is equal to this one standard deviation shock because it's just convenient mathematically, as it would then collapse to this formula. And then we know what was now the effect this shock has on yt plus h, and we are now subtracting the expected value in yt plus h if this shock would not have occurred. So for instance, if you have a time trend or something, or the constant, this would be now excluded by this one. And now we have the impulse response of a shock in variable I on all the other kind of variables. This one is now used in a very similar fashion as before the focused error variance decomposition based on orthogonalized impulse response functions, with the advantage that, or with the disadvantage, that unfortunately this d tilde ij, if you sum it up by row, as we have seen here, do not sum up to 100% anymore. And that's a huge issue, because before this was done by construction. And in order to still create this mechanism or to get this property, what we are doing is now we are standardizing it by the row sum, which means that if the row sum would be equal to 1.3 instead of 1, like for 100%, we are simply dividing all of these elements in that row by 1.3 so that the reweighted impact would be then equal to 100 per each row, so that it fulfills the property by the same mechanism as the orthogonalized impulse response function. And this has also been criticized, and which we will discuss later on then. So now, as you can see, that part here of this table is identical to this one here. And this is already called the connectedness table. So as we can see, it is the connectedness measure, so the connectedness approach is nothing else than an extension of the focused error variance decomposition. So they have matched basically two different concepts, the focused error variance decomposition and some summary statistic, in order to create something new that is essential for the literature. So what we are now doing here is, because if we now sum up each of the rows, we would always get like 100%. So that does not provide us with any information. So what we do is we're summing up each of the rows and then subtract the value on the diagonal, because we're not interested in how the variable influences itself. We are only interested in how other variables are influencing this variable. And we are calling this one the total directional connectedness from others. So it's basically the effect other variables had on variable 1. This is then the effect all the other variables have on variable 2, excluding the effect variable 2 has on itself. And now we are doing it exactly in the opposite direction as well, computing the column sum and excluding the own variance share. And this is then creating the influence variable 1 has on all the others, or on the network. Now, as we have the effect all the others have on variable 1, and we have the effect variable 1 has on all the others, if we now compute the difference, we know that in case this difference is positive, that now variable 1 is driving the network, because it transmits more in terms of focused error variance shock to the rest of the network than it receives. If it would be negative, we would call it a net receiver of shocks, because it is more influenced by the network than it is influencing the network. And then mathematically, if we calculate now the average of all the froms, or the average of all the two spillovers, we would end up with the TCI. And hence the TCI is like an average spillover. It tells us the degree of the spillover that is influencing all the other variables if there is a shock in one variable. So for instance, if it is 70%, it means that 70% of the shock in one variable will be transmitted to all the others in the network on average. What we can also calculate is now the net pairwise directional connectedness. And here we're simply looking on the two effects on the diagonal, on the off diagonal. Here we have the effect that, here we have basically the impact variable 2 has on variable 1. And here we have the impact variable 1 has on variable 2. So if we subtract this value from the other and it is positive, we know that variable 2 influences variable 1 more than variable 1 influences variable 2. And hence, variable 2 is a net transmitter of shocks, or net pairwise transmitter of shocks. Vice versa, if variable 2 is influencing variable 1 less than variable 1 is influencing variable 2, it means it is a net receiver of shocks, of the shock of variable 1, or it is net dominated by variable 1. This is now simply the mathematical calculations as we see it here as well. From the from and the to, difference is then the net. If we are now averaging all the twos, it's identical to averaging all the froms, and it's then our network interconnectedness. This is often used as market risk, because if TCI is rather high, it means that a shock in one of the variables has a huge influence to the rest of the network. While if it would be close to 0, it would mean that a shock in one of the variables is on average not having an effect on any of the others. What we have done then later on was we have run multiple Monte Carlo simulations because we realized that the TCI is not really between 0 and 1. There's an upper limit, and the upper limit is always a k minus 1 divided by k. So for instance, if you have two variables, then the upper threshold is 1 over 2, it's 50%. Because you would always have, if this would be the whole network, you always have the highest value on the diagonal. So in the best case, you have here 50, here 50, 50, and 50. And so the from would be 50 in both of the cases, the from and the to, and the average hence could be at max 50. Which is why we said, okay, we need to adjust the TCI, or we correct it, by not using the average of all the twos and froms, but by calculating the adjusted average by k minus 1. And then it is really between 0 and 1. It does no longer depend on the number of variables you're using. By doing this, we also were able to create another metric, which is the pairwise connectedness index. And the pairwise connectedness index is actually nothing else than the TCI between two variables. The advantage here is that you can estimate a large VAR with, let's say, 10 variables and still compute then the pairwise influence. Hence, all this kind of variables would extract or capture the effects all of the 10 variables have on the variable of interest. And so, while if we would have a bivariate VAR, the problem would be that we are getting completely different values, as 8 of the variables are not considered in this VAR model. And hence, this PCI would be different to a TCI in a bivariate case, and hence being way more accurate. And later on, that can also be used for portfolio management. We also said then that we want to adjust the net pairwise directional connectedness by introducing the asymmetric pairwise connectedness approach. Here we are calculating the net pairwise directional connectedness at the top and then dividing it by its sum. Hence, this one is between -1 and +1 and could be seen in the same fashion as a correlation. And so you could also create a minimum APDC portfolio based on this one. So the first, let's go then to the connectedness approach, to the code. So this is basically an IPython notebook, but it includes the R code because there is this R package, Connectedness Approach, where you can recreate most of our research findings. And for that one, you simply need this library and the SU library to create the right data type. Parallel is just to improve computational speed, and our color brewer is for having different colors than the standards. That's it. We're using in that example an old data set of ours, which includes oil price shocks, exchange rate of oil importers, and exchange rates of oil exporters. We're creating a simple summary statistic, and the most important part here are the ERS, unit root test. Those are telling us whether we have stationary data. If it would be non-stationary, we would not be able to use those time series. And we need to use some kind of transformation first in order to get rid of the unit root process. So for instance, calculating the first differences, the first log differences or returns or any other. Then we have the autocorrelation test. This one shows us whether we should include an AR term. And this one is the link box statistic on the squared residuals, meaning whether we have arch effect. So do we have variances that are varying over time, or are they staying constant? And also here we see that they are significant. Hence, we need some sort of VAR model that is also able to compute time-varying volatility and covariances. If you want to estimate a connectedness model, you simply need this one function. You're including the data that needs to be of type SU. Then you're selecting the numbers of lags you're using, the forecast horizon. The default for the corrected is false, so you would estimate then the Diebold and Yilmaz specification. The model is VAR, and the connectedness is time domain. There's also like frequency domain and others we will get to know later on. And then you're getting the table already. And as we can see here, the TCI is equal to 30, which means that 30% of a shock in one variable will be spilled over to the remaining variables in the network. We see that the net effect for the demand shock, the supply shock, and the risk shocks, they are positive. Hence, the oil price shocks are all net transmitters of shocks in this network, while all the exchange rates, they are receivers of shocks. They are negative. Hence, it means the effect of the others is higher than their impact on the others. This can also be shown here. For instance, the demand shock here from all the others is just 5.6%, but the demand shock or the demand impact to all the others is 90.06. So it's 90.06 minus 5.62 gives you the 84.44. And in the case of, let's say, Japan, we see that Japan is influenced by all the others by 26.35%. And so 73.65% is its own lagged influence, while Japan is influencing the other variables by 13.52. And if we now calculate the difference between the two minus the from, we see that we have a negative net total directional connectedness of minus 1283. The first extension has then been the asymmetric connectedness measure, which was then introduced by Barnik, Cosenta, and Wacher. What they were basically doing is they said like there are positive and negative returns, as well as positive and negative semi-variances. And now what we could do is we are estimating.
Nice.
Yeah. Sorry. Okay. And what is then basically done is now we are estimating the connectedness measures based only on the negative returns first. Then we do the same only with the positive returns. We are calculating then the interconnectedness in the network, and then calculating the differences between the negative and the positive in order to see whether negative returns are more interconnected than positive ones. And in most of the studies, we find that this is actually the case, which is also in line with economic theory. Because what we would assume is that there is a higher correlation during financial crisis when the returns are hitting negative territory than during recovering periods. So later on in 2018, they have, ÖZDEMİR, Diebold, Leo, and Yilmaz, they introduced the lasso connectedness approach. The reason why they had to introduce this one is because they were estimating a financial network, a bank financial network, and having like 50 different kind of financial institutions. And in order to decrease the random impact of some of those financial institutions, they needed some sort of approach that selects the variables. And this is exactly what the lasso method is doing. The first part here of the optimization is nothing else than our OLS model. It just tries to minimize the mean squared error. And the second one is a penalization term. And this one penalizes the absolute value of your regression coefficient. Hence, it would be, the second penalization would be smallest if all the kind of regression coefficients would be equal to 0. But obviously, if they would be equal to 0, then the first term might be relatively large. And hence, it's some sort of trade-off. You can control this trade-off by cross-validation in order to find the most optimal lambda, or you're selecting a lambda yourself. If you want to visualize this, it would look like this. Here, the assumption is we only have two variables, so it's variable 1 and variable 2. This part here would be the first part. It is basically the mean squared error. And this part here would be the penalization term. So where you're penalizing basically W1 and W2. And they are intersecting here. If they intersect here, it would basically mean that now W2 reached this level, but W1, like the regression coefficient, is equal to 0. And hence, if a coefficient is equal to 0, it's exactly the same as if you would not have taken this variable under consideration. If you want to estimate this yourself, what you have to do in this package is nothing else than leaving everything the same, but here selecting the model lasso. That's then basically it. Another extension which we have introduced is the rich connectedness measure. It is theoretically the same, with the difference that the penalization term looks different. So here it is no longer the absolute value of the regression coefficient, it is the squared value of it. The main reason why you would do this is in case your variables are highly correlated with each other. And as we know from financial market theory, different stock market indices are highly correlated with each other. So in the case of using a lasso VR model, the problem might be that if two variables are highly correlated, that you're always switching between the effect one variable has on your output variable and the other one, because one of them will be basically dropped. While here, you're taking this correlation between the explanatory variables into consideration and do not force them to be equal to 0. Nonetheless, this also leads to a higher noise to signal ratio. If you want to estimate a rich VAR model, you simply have then to change the model to rich. And then there's also the combination between the lasso and the rich penalties, where we are introducing an alpha. And here, if the alpha is now equal to 1, it would basically mean that the second term will be dropped, This one here is 1, and hence it is exactly the same as the lasso model. And if alpha would be equal to 0, it means that the first penalty term is dropped and the second one is unity. So you would be back into the world of rich connectedness approach. Now with the elastic net, the advantage is that you have a trade-off between these two. And in order to figure out like what is the optimal alpha and lambda, you can use cross-validation. And this one usually leads to better results when it comes to forecasting than either lasso or rich. And for this one to be estimated, you simply need then to change the model to elastic. So what we have then done in 2024 is we have realized that the problem with the initially proposed connectedness framework is that it depends on a rolling window VAR, which means that you're taking now a window size of 200, and now based on this 200 observation, you're estimating one VAR model, and then you're rolling it over the whole sample period. But there was nothing like a criteria and selection criterion telling you like what is the optimal window size. And it could also be that the window size is changing over the period. So what we said is this might be suboptimal, and hence we said it might be advantageous to use a TVP-VAR model. So it's a time varying parameter one. It doesn't mean like this is the only model that could be used for this one, or it's the best model. It was simply the most efficient one. As usually time varying parameter models like the one that was published by Del Negro and Primicieri are based on MC algorithms. And so it takes an eternity to be estimated, even like on a monthly basis. So in financial econometrics, we often deal with daily or even higher frequencies. And we would not be able to use those kind of models. While the Coop and Corabilis TVP-VAR model are using a dual Kalman filter. And hence it was actually quite fast based on daily data, which was the main reason why we have used this one. Another advantage is that by using this TVP-VAR model, now you can even estimate the time-varying behavior of low-frequency data sets, while this was previously not possible by using the rolling window framework. For that option, you only need to change then the model to TVP-VAR, select then the prior and the forgetting factors, and then you would be able already to plot the dynamic connectedness plots. So here, these ones is the total connectedness index, or in its time varying form, it's the dynamic total connectedness. The theory is that if high levels are reached, it means like there's high interconnectedness. And if there's like an abrupt change as here, we would assume that it indicates a financial crisis, because we would assume that there is higher correlation if there's a market downturn. Leading to higher correlation means then higher connectedness. And here we see that this marks the year 2009. Hence, it could be that this illustrates the effect of the global financial crisis. In 2012, we also have seen an increase, which could be attributed to the European governmental debt crisis. In 2015-16, we had the Chinese housing market crisis. And in 2020, this sharp increase marks then the COVID-19 pandemic. We can then also calculate the dynamic versions of all the other connectedness measures. So here the to connectedness measure illustrates the effect one of those variables has on the other network, on the entire network, while the from illustrates the effect the entire network has on those variables. If we calculate then the difference between the to and the from, we are getting the net total directional connectedness. If it is positive, it means it is a net transmitter of shocks and hence a driver of the network. And if it is negative, it is considered as a net receiver of shocks, or it is driven by the network. In 2014, Diebold and Yilmaz illustrated how the network or the connectedness approach can also be used in terms of the network analysis. And hence, we've also implemented this network graph illustrating the net pairwise transmission mechanism. So it always goes from one variable to another variable, and the arrow always shows in the direction which is net dominated. Hence, it means that the demand shock net dominates Brazil. So demand shock influences Brazil more than Brazil is influencing the demand shock. Furthermore, blue illustrates that those are the net transmitters of shock, so the driver of the network, while yellow illustrates that it's the net receivers of the shock. And also the size illustrates the strength of the net transmission mechanism. So in the next step, then we said, okay, now we have solved this time-varying problem. Nonetheless, we wanted also to illustrate how different kind of market environments might have an effect on the spillovers. Hence, we wanted to be able to differentiate between market downturns and growth periods, and whether there are differences in the transmission mechanism between those periods. And so what we have done is we have used the quantile regression instead of normal linear regression models in order to figure out how is the effect on, for instance, the 10th quantile or on the 90th quantile, and does it vary over the quantile spectrum? So do we see like higher inter-market connectedness at the tails? And this is also what we have observed quite often in empirical research. And if you want to estimate the quantile connectedness approach, you're simply using here the model Q-VAR, and then you're getting the quantile approach. The advantage is that if you're estimating the conditional median and you would assume normality, it should provide you with similar results than the standard Diebold and Yilmaz approach, because given normality, we know that the mode, the median, and the mean would be identical. If you have then outliers, the quantile connectedness approach might provide you with more robust results. And as I said, also allows you to estimate effects at either of the end of the tails. Nonetheless, one question which we asked ourselves is that as our dependent variable always looking at the same quantile, we might face some kind of issues. For instance, let's assume that we have two portfolios and they are long portfolios. Then we would look on the 90th quantile. What is now happening if we still have the 90th quantile, but now one of the portfolios is long and the other one is going short? So now we would assume, obviously, that the correlation has changed, and hence we will also need to change the taus. So the tau or the quantile in the first regression should be 90, while the tau in the second regression should be 10. And so we came up with this quantile and quantile connectedness measure. And this allows you now to estimate the effects of the spillovers across the whole quantile spectrum, taking under consideration different kind of quantiles. Another extension which is quite popular is the frequency connectedness approach. In that one, the spectral decomposition of a vector autoregressive model is used, so that we are no longer in the time domain, now we are in the frequency domain. The interesting part is if we are now aggregating the frequency domain completely, like from -pi to +pi by using the Fourier transformation, we would get the same results as in the time domain. Another huge advantage is that now we don't have to aggregate everything from -tau to -pi to +pi to get the time domain. We can also now create fractions of it. So for instance, if we are interested in all the frequencies between tau and tau divided by 5, what we are basically doing is we're looking on a short-term dynamics because they represent higher frequency. And so it is between the first and the 5th day. So how the dynamics looking between the first 5 days. And from tau divided by 5 to 0, we would look at everything that is larger than 5 days. For that purpose, you simply have then to change here the connectedness variable to frequency, and then create a partition. So as I said, what we are doing is we're going from pi to pi divided by 5 to 0. And this means that it's actually pi divided by 1, so it's between 1 and 5 days. And that part here will be illustrating the spillovers, everything above 5 days, so long-term dynamics. And this is also some sort of decomposition, because if we, as I said, like if we aggregate the short-term, medium, and long-term dynamics, we will always end up with the time domain. Hence, now we can know whether the short-term dynamics are the ones that are creating this volatile behavior, or something is going on in the long-term dynamics. What research has seen is that whenever the long-term dynamics are changing, it basically means that the market structure is changing, while short-term dynamic changes are often associated with speculations. So here, for instance, in the long term, we see that there is a hike in 2009 for the global financial crisis and in 2020 for the COVID pandemic. We can also create then the net total connectedness based on short-term and long-term dynamics. So this is then all when it comes to the different kind of frameworks. Now we're coming more like to the minor extensions. The first one would be then the aggregated connectedness measure. So in our case, what this would mean is we would like now to look at different groups. So the first group might be the oil price shocks. Even though we have 3 variables, we want to have now like an aggregated measure for it. Then we also have all the oil importing exchange rate and the oil exporting exchange rates. You have to imagine that the larger the network is, the more difficult it will become to explain all the spillovers. By aggregating them, like interpretation becomes easier, and you also can find some sort of pattern easier. In our case, as I said, we're having the oil shocks, the oil exporters, and the oil importers. And by using now the function aggregated connectedness based on the DCA, which is nothing else than the connectedness approach you have chosen to estimate, and the groups variable, you're getting like the aggregated connectedness measures. The aggregated dynamic connectedness would look now like this. Here we see exactly that the global financial crisis, we still have this increase. Here in 2012, it is still the same. We have the European governmental debt crisis, the Arab Spring. In 2020, it's the same, but interestingly, now we can explain the net dynamics on a more aggregated basis. So the oil shocks, for instance, appear to be the net transmitters of the shocks, transmission mechanism, while the oil importers and the oil exporters are clearly the net receivers of shocks. If we look at it on a bivariate case, we see that the oil shocks are net influencing oil exporters and also importers. So here, the effect of oil shocks on oil exporters is higher than on oil importers. And oil exporters apparently are net dominating oil importers, which also makes sense theoretically. In the next step, we wanted also to decompose the connectedness measures into internal as well as external connectedness. So what does it mean? Like internal means within the group, and external means between the groups. And what we have done here is we are taking the original connectedness table but now we are having like different groups instead of the individuals, and say like the internal groups are the one on the diagonal. So where, for instance, oil shocks are just influencing each other, only oil importing exchange rates are influencing each other, and oil exporting variables are influencing each other, plus whatever is left. So those would be then the external shocks between the groups, without considering anything internally distributed. For that purpose, we have the function, the internal connectedness. We're using, again, the DCA, which is our estimated dynamic connectedness approach, and the specific groups we have. Now the internal spillovers, as we can see, is here on the diagonal. We have values that are different from 0, while on the off diagonal, they are all equal to 0. And then we are simply calculating the normal connectedness measures. I think it's more illustrative if we look at network graphs. So here we are seeing that there are only transmission happening within groups, but there are no influences between the different kind of groups. And if we look on external connectedness measure, we see exactly the opposite. So now on the block diagonal, we only have zeros, but on the off diagonal of the blocks, we have values that are non-zero. And in the network plot, this could be illustrated as follows. So here we see that there are no spillovers between the oil shocks. There are also no spillovers across the exchange rates. However, there are then all the remaining spillovers still visualized. Interestingly, now we can also decompose the market risk. So we can first decompose it by the internal connectedness, which is here this blue line. And this is the aggregation of the individual TCI. So this is now the market risk of oil importers, the market risk of oil exporters, and of the oil shocks. If we look at it from an external perspective, like from the external shocks, we see that the largest fraction actually comes from shocks that are between the groups, not within the groups. And here, the largest part is definitely the oil shocks, especially here from 2009 to 2013, which is exactly the period that is covered by the global financial crisis as well as the Arab Spring, and here in 2020 when crude oil reached negative territory the first time in history. So if we now aggregate all the external TCIs, we're getting this blue line here. And if we are aggregating all the internal spillovers, we're getting this blue line. And if we're now aggregating the total internal TCI and the total external TCI, we're getting back to our original TCI. And hence the main advantage is that we are decomposing it in order to get further insights into the overall dynamics. In the next stage, we said we want to do something similar, but sometimes it's really useful to exclude some specific kind of group, as it was exactly in this use case. So we have invented the partial connectedness measures. Here we have again our three groups, the oil shocks, the importers, and the exporters. And we said, actually, this study should just be about the oil price shocks and how it influences the importers and the exporters, and how importers and the exporters are influencing the oil shocks. But we are not interested in how the exchange rate of oil importers and oil exporters are influencing each other. This could even like bias our result or provide us with insights that are not useful. So what we have said is we have again this overall connectedness table. And now we are just partitioning it differently. We're saying that there is the inclusive connectedness table. The inclusive one is including this one group we are interested in, the oil shocks, and how it influences the other groups. And then there's the exclusive connectedness, the kind of spillovers we're not interested in, which are the spillovers within the oil importing countries, exporting, and between them. And this one can be calculated as follows. We're just using the inclusive connectedness, using again the DCA, the dynamic connectedness approach we have estimated. Then we simply say like the inclusive group should be 1, 2, and 3, which is the oil demand shock, the oil supply shock, and the oil risk shock. And also, as we can see here, all the dynamics between the exchange rates, they are all down to 0. While the dynamics between the oil shocks and the exchange rates are all non-zero. And then we are simply calculating the to, from, and net spillovers as we used to know from the Diebold and Yilmaz framework. From a network perspective, it looks like this, which looks pretty similar to the external spillovers. However, here we are also taking under consideration the spillovers between the oil shocks. And if we calculate the exclusive network, we would get this network graph. So we are excluding the group that is of main interest for us in order to get rid of the dynamics we might not be interested in. And in that very case, for instance, Norway would be upward biased based on analysis, because within the exchange rates, Norway is a net transmitter of shocks, which would then increase its net spillover power, while we are only interested in how does Norway behave in terms of oil shocks. Here we have exactly the same option. We can calculate the market risk between the inclusive group and between the exclusive groups. And interestingly, we see here that the red TCI, which represents the interconnectedness of the exchange rates, we are not having here any large effect for the COVID pandemic. So apparently exchange rates were not heavily affected or heavily correlated during that time. Nonetheless, we see that the oil shocks have caused this large increase in the dynamics. Afterwards, we also said that now we would like to calculate something like sub-connectedness systems, but they also need to fulfill the properties that the row sum is equal to 100. And so what we have done is we are partitioning again the connectedness table into our 3 different groups. Here we are only interested in the diagonal group dynamics, and they are now representing the oil price shocks, the internal one. But here now we are normalizing the row sum so that it represents 100%, trying to figure out how the internal dynamics would look like, even if we would consider the effects all the others have on the oil price shocks. For that purpose, we can use this conditional connectedness approach. We are simply specifying the group we are interested in. And then, as we can see, it is just extracting that part, standardizing it by 100, which can be seen by 86.34 plus the from is equal to 100. And it now estimates the TCI and all the other relevant measures on a sub-connectedness basis, providing us with further insights about the dynamics on the market risk level, as well as on the net transmission mechanism. So now we're coming to another topic, to the connectedness to the R squared. This one was actually, I think, a quite interesting paper, because we have asked ourselves, what is happening to the connectedness approach if we have VAR coefficients that are all insignificant? So for instance, the efficient market hypothesis would be true, and hence we cannot predict any future values. So in that very case, YT, all our stock market returns, would be a random walk process. Nonetheless, this has a specific kind of dependence on each other via the variance-covariance structure. And if we would now convert this one to a VMA model, the theta 0 is equal to 1, but all the others are equal to 0. And hence, the generalized forecast error variance decomposition would collapse to this fraction here. And this fraction, if we're now putting like the squared out of it, out of the bracket, we see that whatever is left over is nothing else than the Pearson correlation coefficient. And if we square the Pearson correlation coefficient, we have the special case that this represents the R squared of a bivariate linear regression model. So if we are now using the R square instead of the generalized forecast area variance decomposition and try to normalize it by rho so that it is 100%, we're simply getting reweighted R square values. And so we can now match the connectedness approach with the simple R square. Now the problem is just that if we have like a multivariate linear regression model, the R square, if we take under consideration all the independent variable, is not equal to the R square of all the bivariate linear regression models. This is like a statistical property. It only would be the same if all of the independent variables are not correlated with each other. And this causes now some issues, because what we tried now to do is we try to overcome this normalization issue. We did not want to do always this row normalization, because there is a large body of literature that says, like, depending on the normalization, you're always getting different results. And it doesn't mean that this is actually meaningful. And so now we wanted to come up with a different approach. We said, okay, the from connectedness is now represented by the R square of a multivariate linear regression model. So now what we have to do is we have to figure out the R square contribution of each of the variables. But how can we do this? We need to make the independent variable somehow independent and then calculate the contribution of each of those variables. And this is exactly what can be done via principal component analysis. And so we have followed the Gelisim procedure, which is nothing else than if you have like 4 variables, you're calculating now 4 principal components. All the principal components are independent of each other. And then you can recalculate, or then you could basically estimate the R square value of the bivariate regression models between all the factors. And if you would compare it with the multivariate linear regression model based on all the factors, you get exactly the same result. So in terms of R square. So the only problem we now have is, how can we translate from the factors R square, how much of them accounts for each of the variable itself? And for that problem, there was a solution provided by Gelisim in Statistica Sinica in '93, where they have basically pointed out that R square can be also computed in a different way, based on correlation coefficients. And so what we are doing is now looking on our multivariate linear regression model, which we can do because it is a VAR model is basically equation by equation OLS, and always compute the variance between the dependent variable, the variance covariance matrix between the independent variable, and the variance covariance matrix between the independent and the dependent variable. If we are then standardizing it, which we are basically doing by using PCA, because it has a mean of 0 and the variance of 1, we're getting the correlation matrix. And then we simply have to follow the Gelisim procedure, because R square could be now calculated as the correlation between the independent and dependent variable, the inverse of the correlation of your independent variable times the correlation between the independent and dependent variable. So in order now to get contribution, what we actually need to do is, this one is a scalar, so we need here a 1 cross K matrix and a K cross 1 matrix, which means now we somehow have to decompose this factor into 2 factors. And how can we do this? Like, how could we now decompose this variance or this correlation matrix? This can be simply done by using singular value decomposition, because the singular value decomposition would then allow us that if we are just using the square root on the diagonal eigenvalues, that we are simply generating something like the square root of this correlation matrix, which is this one here. Then we simply have to calculate the Rxy times this fraction in order to get an R square contribution, which illustrates now how much each of the variables contributed in terms of R square. And if we now calculate the sum of this R square contribution, we get the same as the overall R square. So it's a perfect decomposition. Obviously, because this is very generic, and the X could represent, as we have done like in the first case, just the contemporaneous effects, we could also expand it by including the lagged effects. And so we also extended the initial version to the contemporaneous and lagged R squared decomposed connectedness. And later on, which was published last year, we provided the first connectedness approach that also accounts for exogenous effects, where we account now for variables that are not endogenous variables in the VAR framework to provide even like more granular insights. For that purpose, we simply have to use the following code. It's again the data, the number of flags. If you put it equal to 0, you only account for the contemporaneous R squared decomposed connectedness approach. You have to choose a rolling window and the R squared connectedness approach. And now we can see how much of the overall dynamics actually comes from contemporaneous shocks, the blue one, which is like the majority, as well as for lagged shocks. We see here that there was a sharp increase in 2020, which is of crucial interest because while there's an upward trend here for contemporaneous shocks, this substantial increase we see in the overall shock transmission mechanism comes actually from the lagged propagation mechanism. We also can then illustrate it in terms of net total connectedness. And what we have then done afterwards was, when we looked at these formulas, we said, okay, now we can even, in order basically to create a time-varying approach for this R squared decomposed connectedness idea, we would need nothing else than a time-varying dynamic conditional correlations. And for that purpose, we are now using the DCC gauge model, because the DCC gauge model provides us with dynamic conditional correlations and dynamic conditional variance covariances. Based on this RT, we can now basically plug it in to these formulas and get also time-varying contributions. This is now the final part, and it now explains how is now connectedness related to portfolio management. Because back then, the main issue was that while the connectedness approach was meaningful and provided a lot of insights, the main issue has been that there was basically no connection between the connectedness approach and portfolio management. What they were mainly doing back then in the research articles was calculating the connectedness approach, and then in the second step, estimating a DCC gauge model, getting the time-varying variance covariances or correlations in order to calculate the minimum variance portfolio or correlation portfolio. Nonetheless, from a statistical perspective, this is not really correct, as you would assume that there's one data generating process. And if you first estimate a VAR model, you would assume that this is the data generating process. But in the second stage, you're estimating then the DCC gauge model, which has completely different assumptions. And so what we have done is, we said, okay, we need also to somehow try to figure out whether there is something like a metric that could be used as a risk matrix, like QT here, as this represents the minimum risk portfolio. Basically, this is a risk metric, either it's variance covariance or the correlation, and then we're selecting a specific weight vector, that the sum of all the weights have to be equal to 1, and this is not necessary, but it's often used, that all of the weights are between 0 and 1. If now QT would be equal to the variance-covariance matrix, we are calculating a minimum variance portfolio approach, like Markowitz was lining out. If we are using the correlation matrix, we are in the world of Christopherson with the minimum correlation portfolio. And what we have done is we have used the PCI. Because it was symmetric, like every variance-covariance matrix and the correlation matrix, it is always between 0 and 1, like a correlation matrix is between -1 and 1. So it fulfills basically all the properties. And based on several research articles we wrote, we have figured out that the PCIT actually works similar to the minimum correlation approach, but it leads to higher Sharpe ratios. And hence, the introduction of the minimum connectedness approach has now combined the connectedness literature with portfolio management. Later on, we also used then the R-square decomposed connectedness measure in order to calculate another kind of portfolio. This also improved the performance slightly. Nonetheless, it's rather similar as the dynamics are similar. Finally, if we are calculating then the portfolios, what we can also do is trying to figure out whether this led to a decrease in the investment risk. And so we are following here the hedging effectiveness approach of Etherington. And here the hedging effectiveness is nothing else than 1 minus the VAR of the hedged position divided by the unhedged position. And this one actually looks pretty similar to an R-squared. And hence, if the hedged position would be equal to 0, like there's no variation, it would mean that the hedging effectiveness is equal to 1, or R-squared is equal to 1, meaning that the investment risk was able to be reduced by 100%. So now we just need to figure out what is the variance of the hedged and the unhedged position. In the case of the unhedged position, we are simply selecting one of the stock market returns we have. It could be either one because we are calculating the hedging effectiveness with respect to all of the market. And so it could be assumed that it is nothing else than a portfolio where we invest 100% in one market and none in the others, while the hedged position is based on the weights we have calculated via the minimum connectedness approach. And here we have also seen that it leads mainly to significant decreases in the investment risk, proving that the minimum connectedness approach is a solid framework that could be applied also in empirical research. So what are then the main takeaways? So what we have learned is that the VAR model is nothing else than a generalization of an AR model, and an AR model is a specific case of a multivariate linear regression model. We can estimate the VAR model in different kind of aspects. So either OLS in a Bayesian way with a maximum likelihood estimation based on different distributional assumptions. And using the Granger causality provides us with information about the market interdependencies. If no markets are dependent on each other, it basically means that the VAR would collapse to an AR model. What we can also do is using VAR models for forecasting, which also helps us in terms of portfolio management, as we need like an expected return in the future. The impulse response function forecast error variance decomposition can be computed. And based on the forecast error variance decomposition, we can now create our connectedness measures using any kind of connectedness frameworks. Here, the identification is either we are following an orthogonalized focused error variance decomposition or the generalized version. The generalized has the advantage that the variable ordering doesn't matter, while in the orthogonalized one, you would need also an economic theory why you're ordering the variable the way you do. And so we are calculating then the two from net, the net pairwise directional connectedness, the PCI APDC, and the TCI connectedness measure. We have now shown different kind of models that can be used, a standard VAR, TVP-VAR, quantile VAR in order to see like the different market dynamics in the tails, as well as Lasso for variable selection, the ridge for highly correlated variable, and the elastic net to find a sweet spot between the lasso and the ridge model. There are different kinds of connectedness frameworks, which are the original time domain one, later on the frequency connectedness approach by Baranik and Kralik, that if aggregated from -pi to +pi, results in the time domain connectedness measures. Then the decomposed in order to figure out the internal and external spillovers, the partial for the inclusive and exclusive one, because you might care more about one dynamics than about others. The conditional one to zoom into one specific sub connectedness in order to figure out the internal connectedness there, or the aggregated approach if you have too many variables and you need more or less a good overview, like a summary statistic of it. Then we have seen that connectedness and the R-square value are closely connected, namely the generalized focused error variance decomposition would collapse to an R-square, weighted R-square values in case the VR coefficients are all equal to 0. Based on them, like multiple approaches have been created, like the contemporaneous and lagged R-square decomposed connectedness, or the time varying version with the DCC gauge model. And finally, we have seen that the connectedness measures can be used for portfolio and risk management purposes by estimating the minimum connectedness approach or minimum decomposed R-square connectedness portfolio, which can be evaluated based on the Sharpe ratio or the hedging effectiveness score of Etherington. So I know this was a long presentation. Nonetheless, I hope that you enjoyed it and that you also understand now how the connectedness framework works and how it might be useful for your upcoming research. Thanks a lot for your attention.
David, thank you so much. Thank you so
You're
much.
welcome.
This is really, really so informative for all of us. And we learned so many theoretical bases of your models, and it's really so informative. And I know you are a little bit tired, so
No,
I don't
all
want
good.
to do too many things, but I can go with the QA session. And maybe our participants can ask some questions. And I took several notes from your presentation, and I have a couple of questions, but I will just only restrict myself by only asking 2 of them, very short questions. Maybe I can open this session by asking you a very short question. In your study, David, using the TVP-VAR framework, or the others, how do you handle the trade-off between model complexity and overfitting problems, especially when including a large number of variables with time-varying parameters? I just, maybe I missed this point in this case, and you can go with this question, or I can ask the second one, and maybe
let me please answer that one, because otherwise I might forget. So that's actually a really good question. And the problem is still like there is no real answer to it, because the TVP-VAR model provides most flexibility, or it's the most flexible connectedness model. Nonetheless, the problem is that if you have really large dimension, it might also lead to instabilities across the VAR coefficients. So I would not recommend using this model with more than 25 variables, for instance. And as soon as you would have more than 25 variables, you would have to look like for alternative approaches. So then I would always go with a lasso model, for instance, or ridge model, like a penalized regression, which also selects the variable. So out of, let's say, 50 variables, you only have then 10 variables left, the most important ones. And this kind of lasso approach is also incorporated in the quanta connectedness approach, because while we have never published a paper about this, the code is already available by using like quanta vector autoregression with that is like using the penalization of lassos. So that's also really helpful. And there's now a paper that was published in the Journal of Financial Econometrics. They are doing something similar, because they are saying that we see this high interdependencies across the network at the upper and the lower end, which is potentially artificial, and mainly due to the case that some of the coefficients are insignificant, but they are not equal to 0. And this would solve that issue.
Thank you, David. Thanks so much. Maybe I can go with the second one. It is a little bit related with this one. So, in your experience applying the connectedness approach, so how do you explain the cases where the total connectedness remains high, that you gave some examples about it, but directional spillovers between specific markets are low? So could this indicate the hidden dependencies or structural nuances not captured by the standard measures or something else?
Yeah, I mean, that would be a good explanation for it. And this is also what was one of the main reasons why we have introduced all this kind of group-specific connectedness measures. For instance, I think it was around 2020, we wanted to investigate like the network spillovers of different financial markets, and also included cryptocurrency. Without cryptocurrency, the TCI was actually quite high, which we would have expected. But with cryptocurrency, as correlation is low, the overall TCI dropped significantly. And we said, like, it is a bad idea to have like one variable that is completely adjusting all of the dynamics. And so what we offered them back then was creating sub-connectedness.
Sub-connectedness.
That basically illustrates the impact by adding one variable on the overall TCI. So for instance, if you have still like all these 5 variables, including cryptocurrencies, then you would plot then the TCI, you exclude the cryptocurrency, plot it again, and see like this is basically the effect cryptocurrency has on the overall network.
You use an indirect way to solve that kind of, problems.
Yeah, because
not directionally using a method, but indirectionally you use some groups and sub-connectedness, and then go with it.
So let me have a quick. Let me show you some. So, maybe it's to show this. So, for instance, this was how we tried to solve this issue. So, for instance, it's at the very top somewhere. If this is the overall connectedness table, then we could assume that we have now here a variable that has no connections to the others. And then we were thinking, okay, how would it look like in the connectedness approach? So if it would be completely independent, every kind of entry would be 0 in each of the directions. Only the own variance share would be equal to unity. And then we said, okay, this is now by how much it would influence it if it has no connection whatsoever. And then we are adding this variable and showing that this is exactly what would be the effect and how much does it differ.
Thank you so much. It's very good. Thank you so much.
You're welcome.
My questions are 2, only 2. So, but I can increase them, but I want to stop in and just maybe the other questions can come from our Gökhan Hoca is asking a question. I have to just a little, as in Turkish, I guess. Give me a minute. I will interpret this one. David, he actually wrote in Turkish, but I will translated it. He thanks a lot, and to see the wide range of connectedness, he's saying that is very informative to see the whole context. He says that is starting anew in that connectedness approach, and he is learning newly to your method. He just wondering that TVP-VAR models. How we can be elastic in terms of the kappa values. So when you explain the macroeconomic shocks, like in Turkey, in emerging countries. And the second question is, in the connectedness values, SSA signals that you use, SSA signals minus models that you use it. So how it can be important for dynamic spillover values or approaches to understand the reliability or robustness in the model?
So the first one, with respect to the kappa values, what you could do is you're doing a forecasting experiment like what we have done in this TVP-VAR article. We run basically a forecast exercise for all the different values between kappas of, I think, 0.95 and 1. So 1 would then be illustrating like a constant parameter VR model, and have shown that for monthly time series, the best option is, I think, 0.99 for the VR coefficients and 0.96 for the variance-covariance matrix dynamics. And this is also what Coop and Kourabilis have done in 2014. So for that purpose, whenever you have like a monthly or quarterly time data set, I would just recommend doing a forecasting experience, figuring out like what is the optimal model, and use this model then for the connectedness approach.
Thank you.
Unfortunately, I was not really sure what was meant with the second part of the question.
The second one is actually, I'm so sorry, I disturbed you, but applying the signal extraction method, like SSA, singular spectrum analysis. So before connectivity measures, so such as TVP-VAR, can have both benefits and potential drawbacks for the reliability of dynamic propagation estimates. So how it can create problems, or whether it can create a problem or not, or how we can solve it, there's a problem or something else.
So if I understand it correctly, it's more about the parameter stability, or
yes,
the VAR
yes,
model?
That's it.
That's actually, yeah, that's a real problem. And that's also why I always encourage people to implement new TVP-VAR models, because there are for sure like 20 or 25 of those TVP-VAR models out there. And as soon as they are implemented and you're extracting the regression coefficients and the variance-covariance matrix from them, you can easily plug it into one of the other functions and estimate all of those connectedness measures again. As I said, like, I completely agree that maybe this TVP-VAR model is like not the most appropriate one and potentially lead to parameter instability. The main reason why I used this one was as it was the only one that works with daily data sets, also with large daily data sets. We implemented, I think, 3 or 4 different versions, but the one from Primitieri and Del Negro, I think it was running for 1 week, and we haven't still received any results for a small daily data set. I think it was just like 8 variables. And while this one potentially have created more stable parameters, it is simply not feasible. And also from a portfolio management perspective, if you would use
it creates a problem for reliability of the measures, right? So
yeah, it does actually. This is also why I would always recommend using as a robustness check the Diebold and Yilmaz approach, and compare the dynamic whether they look similar. And if they look similar, to see how fast they are changing when it comes to different historical events. Because what we have experienced is that the TVP-VAR model adjusts faster to any kind of financial crisis. And obviously, from a risk management perspective, you're more interested in the models that are capturing those events faster in order to rebalance your portfolio, for instance.
Well, thank you so much. Thank you so much. So, my dear participants, whether there are any questions or not, We're just waiting here. I think that they don't have any question, but David, really, thank you so much. So you gave a very informative, points. It's really so nice to see your presentation, and it's a very honor for me and my university, my department, to see you. So in this university. So thank you so much. Thank you so much.
Thanks a lot for the invitation. It was a pleasure. Hope to talk to you soon. Have a great day.
Have a great day. Thank you so much, and see you. We will talk again, and we will go further. I'm still saying that I want to write something with you. I'm still on that. So if you have any time, of course, I'm making a job. If you find the time, it's a very honor for me to work with you and do something.
I would look very much forward to it.
Oh, thank you so much. Thank you so much. See you. And thank you. Okay. Bye bye.